would like, if I may, to take you on a strange journey.
Hello, everyone, and welcome to another edition of Real Estate Realities with the Rebel Broker. My name's Robert Whitelaw, and I am the Rebel Broker. Licensed real estate broker in the state of California, member of the National Association of Realtors. But please, don't hold that against me. Welcome to it, folks. We're going to cover a few different things. We're going to sort of suggest some market updates, what's going on with interest rates, what's happening with mortgage originations, those types of things. Just some things that give us an idea of the level of activity. A lot of these things are going to fit in really well with things that we've already talked about over the last few weeks in terms of establishing sort of the known trend. And one piece of good news that I think we can at least use as something to anticipate a little bit of a change down the road. Also, I wanted to hit a list from Housing Wire where they're talking about what they claim are the top markets to invest in rental properties. This is something we like to cover on a pretty regular basis, as much because these are typically places that nobody has talked about at all, or some that you're surprised that they're talking about in the case of some of the more challenging communities. But I thought we'd run down the list and give you that top five like we like to do. But before we jump into that, I think I'll save that probably towards the last portion of the show. I wanted to get into some of these other sort of tidbits. And before we jump into that, let me remind everyone that the best way to get in touch with me is through the website at therebelbroker.com. From there, you can click the contact button in the menu bar. Send along any ideas, suggestions, observations, or questions that you might have. Be happy to reach back out to you with a response. Of course, while you're there, you'll also want to get in on the monthly $50 Amazon gift card drawing. Now, the way you do that is to click the big red button at the top of the webpage at therebelbroker.com titled Take the Survey to Support the Show. You'll be supporting the show. You'll be helping me out by answering a few demographic questions, but also by providing your email address. You'll be putting yourself into that drawing for the $50 Amazon gift card. So thank you to all of those who have already done the survey. You are in the drawing. Your email's in there, so don't worry. When we do the drawing this Friday at 5 p.m., that's the cutoff for this month's drawing, 5 p.m. Pacific this Friday. So you got 2 more days. Then on Monday, with any luck, I will have reached the person who won, and I can let everyone know that that's happening. If not, I'll draw another. If that email ends up being dead, I'll draw another person. But we do it every month. We've given away hundreds of bucks, 400, 450, somewhere in that ballpark. Congrats to the folks who've already won, and good luck to all of you who have yet to win. We are now at a point where the 30-year fixed rate mortgage has dipped below 4% again. This has been sort of the trend. Things go down, things go up. Week to week, it seems to be making these sort of gyrations. But I think it's important to understand where interest rates are. I think for a lot of you, it's clearly a factor. It determines what your monthly costs are going to be. Now, the 30-year fixed rate mortgage is currently at 3.97. That's down 0.03. 15-year fixed rate mortgage is currently at 3.23. It was at 3.25, so that's down 0.02. The FHA 30-year fixed rate mortgage is at 3.65, down from 3.75. The jumbo 30-year fixed is at 4.25, down from 4.29. And the 5/1 adjustable rate mortgage is down to 3.02, down from 3.05. In fact, the only rate that's above 4% is the jumbo rate, and that's not terribly high above. So even borrowing money at the jumbo level is still good for you. So there you go. Easy money is still there to be had. You can mix this in with the other things that we've talked about in the past few weeks about the increasing access to lending that folks are getting. And remember, I know I like to remind you of this every time we talk about it, because they are, whenever you're hearing about the push, we want to reach out to more home buyers. We want to make lending more available to more people. Nobody is talking about reaching out to more qualified buyers, right? Because there's no need. There's a bar, and if you're above it, you can borrow money. And if you're below it, you need to work on your credit. You need to work on your financial knowledge, whatever it takes to make you more financially responsible so that you're now above that bar and you can borrow. The scary thing is that they've been moving this bar down, or I think a better way to phrase it, they haven't actually been moving the bar down. They still claim, well, you have to have this credit rating and these other things. But what they've done is they've given people boxes to stand up on to get over that bar by artificially bloating folks' credit scores. And you can check out any of the shows I've done over the past couple of months relating to this topic. Very scary. And the number of folks who are affected are in the millions. So we're talking about millions of people who are potentially going to be having access to money that they wouldn't have had access to except for these changes that have been made to how your credit rating gets calculated. And then, of course, we also have the wave of folks who are going to be coming out of that 7-year time frame relating to bankruptcies and foreclosures. So they'll suddenly be in the borrowing zone again. And all of that happening with a increase in buyers. I think everything we've seen does spell an increase in buyers. I'm just not seeing enough things that spell an increase in inventory to offset all of that. So for all of you responsible borrowers out there, congratulations. You can now get some very cheap money. Of course, it's been relatively cheap for a long time. We're just below that 4.0 magic number. Next, I wanted to hit on something interesting because it still shows that the markets are still going crazy out there. The Denver luxury housing market has set some new records. 38% more homes sold in May. According to Forbes and the Denver Metro Association of Realtors, shows a new record of 179 homes priced that sold that were priced over $1 million in May. This is an increase of 21% from the month before and 38% from last year. Quote, by this time next month, sales in the luxury market of homes priced over $1 million will likely surpass $1 billion year to date, said Elaine Stussy, that's the Denver Metro Association of Realtors Market Trends Committee member and Metro Denver real estate agent. Quote, this is a stunning trend in a month where traditionally the greatest number of homes come into the market. However, instead of a buildup in supply, there was a full 1% reduction in months of inventory to a 5.8 month supply. Average home prices increased 2.84% in May from the previous month, and increased 9.83% from last year. Of the available listings in the market, only 41% are priced below $500,000. The competition for homes under $500,000 is fierce, as this price segment is below 1 month of inventory. Considering this price range accounts for 74% of all sales in the Denver metro area, home buyers should expect continued competition. So, and competition equals higher prices. That means more bidding. That means more frenzy. And that's not a good thing, really, from where we are. We really need to get this supply side issue dealt with. In other news, and I think this is good news, this is meant to offset those things we've been talking about. Framing lumber prices are up year over year. And that's good news. If you're consuming more lumber, that typically means more construction is going on. And of course, more construction is a good thing. If we blend that with what we were talking about a couple of weeks ago, where sort of what builders seem to be thinking is changing. And now remember, my local information on this indicates that's not what's happening in homes that are coming online right now. And that is that they seem to be leaning more towards this idea of building more entry-level homes instead of higher-priced homes. We've had a couple of articles come out that indicate that. That would be great news. We're going to have to see if the truth on the ground reflects that. But as I mentioned earlier this week, or was it late last week, when I did a quick review of all the brand new construction that's now coming available for sale, very, very small number that were even vaguely close to what we might call reasonable. Nearly all of them were, out of the 28 or so that were available, 4 of them were in the quote unquote reasonable range from $670 up to $800 and something thousand. All the rest of them were over 1.3 million, which is clearly not even anywhere close to reasonable, even in my marketplace, where the average prices in the communities where these were being put was substantially lower than those prices. All right, mortgage originations is another little tidbit I wanted to share because it's an interesting number to note that despite the fact that well, because of the fact that we have so little inventory and we still relatively have a low number of buyers, which is also odd, right? We have low inventory. Comparatively speaking, we have a relatively low number of buyers, or at least folks who have successfully bought, which is clearly fed by the low inventory. But mortgage originations went down 34% in the first quarter of 2017, led by a 45% drop in refinancing. So that's kind of interesting. There's usually a huge push for this kind of action to happen. This is considered one of those things that is good for this kind of money to get lent. And I think that's one reason so many folks forget about the other end of the equation where you end up saddling people with these crazy amounts of debt. And I think that's one reason why we see so many pundits wanting to push for approving more borrowers rather than creating or getting out of the way of builders so that they can build more homes. The scary thing is that regardless of whether you want to argue about the specifics of what is being done and whether it's a good thing or a bad thing, if you look at the results, what it's creating, these are all the same things that led up to the downturn in 2007, 2006, right in that ballpark. So what really concerns me is this tendency towards a great deal of debt and having so much of this debt being just out there. There's a lot of talk now about the potential first domino in all of this being car loans, excessive numbers of car loans that are now delinquent. Now, I've also got a little bit of data for you on that. The folks at Zero Hedge are our favorite folks in terms of us wondering if we should get fitted for a tinfoil hat from time to time, or sharing some interesting numbers. And they're putting forward that the subprime 2.0 problem that we're going to experience very well could start with the auto loan industry. Auto loan defaults are soaring, hitting 11.96%. The last time they were anywhere near these levels was in early 2008, right before the credit crisis hit. The subprime auto loan industry is just the tip of the iceberg for the current debt bubble, according to the folks at Zero Hedge. All told, the world has added $57 trillion in debt since 2008, bringing the total debt in the world to $217 trillion. That means that globally, the world is sporting a debt to GDP of 325%. When your debt is at 100% or more, that's panic time, right, for countries. When the debt crisis begins that they're anticipating, central banks will be powerless to stop it, as they've already used up most of their ammunition during the 2008 crisis. The ammunition being printing up tons of money, which is why we ended up with $217 trillion in debt overall. So there's that, which whenever you read something like that, you have to think, okay, here is a theory on the absolute worst case scenario. But the one piece of data to pull out of that I think is something that will keep you up at night, but isn't quite as nuts as some of the other things they have to say, is the bottom line is the fact of the matter is that auto loan defaults are rising. Remember the list of things that we talked about that folks would stop paying in dire times, and auto loans weren't up there at the top. But we are definitely seeing a uptick in the number of folks, up to a pretty shocking 11.96% of auto loan defaulting. So that's a concern for me, because it's the thing that leads up to the actions that folks take when they get into any kind of heavy financial problem. And that's really what led up to the dominoes that occurred last time that dropped us into the recession. All right, we're going to take a quick break there after we've kind of had a nice little buffet of different little news tidbits. Next, we're going to go ahead and hit that list of the top markets to invest in rental properties, according to the good folks at HousingWire and CoreLogic. So don't go away. We'll be right back.
Are you ready to jump in and start your search for your first investment property? Maybe you've decided that it's time to own your own home, or maybe you're ready to sell your home and move on to something new. No matter what your goal is, the Rebel Broker can help. That's right, aside from hosting this show, I am also the owner, broker of Whitelaw & Sons Real Estate Services right here in Silicon Valley. With over 25 years experience serving Silicon Valley, Morgan Hill, San Martin, and Gilroy, I or one of my great agents can help you achieve your goals in real estate. So if you're ready to look into taking that next step towards achieving your real estate goals, point your browser at www.soldbyrobert.com. That's www.soldbyrobert.com and get in touch. Let me show you how I will earn your business and your respect. Again, that's www.soldbyrobert.com, or you can call me at 408-852-0525. California Bureau of Real Estate ID 00984-909.
Welcome back, everyone. Well, we're sort of we did for the first part of the show, sort of a survey of different data points. Borrowing obviously going to be great for you in terms of how much it's going to cost you. Bad in terms of how much debt we're looking to saddle folks with. And this will just, again, artificially push prices higher and higher and higher, since we're really throwing all the logs on the fire that feeds creating buyers as opposed to creating the product they want to buy. CoreLogic chief economist Frank Nothaft. Nationally, home prices were up 6.9% over the last year, and that's the latest data for this month. While rent growth for single-family rental homes recorded a 3% rise through April, according to the CoreLogic's Single-Family Rental Index. Now, this is an index I love to look at. It gives us some good insights into what communities we might be wanting to consider in terms of getting the most bang out of our investment buck. Some of the highest-ranking metros were located in the Midwest and Northeast. Now, and remember, so there's really there's two different strategies that you can follow here. And I know I often will suggest not focusing on the headline ones like San Francisco, San Jose, Sunnyvale. And right now, yes, those are relatively bad. Those are bad choices in terms of looking for positive cash flow. Unless you are going to be buying the whole thing, and then return on investment percentage isn't that great. However, if you still feel that we are not at the tippy top of that marketplace and you want to ride the increase in the valuation of the asset itself, the house, some of those may still be a decent option for you. Every once in a while I'll get emails. I got an email from a listener the other day where they said, I would still want to buy in San Francisco because I still feel like those are just going to keep going up and up. And, I don't necessarily disagree that in the near term, those prices are going to continue to go up. It really depends on what you think is going to happen in the marketplace. In my local marketplace, I think that we're going to be hitting a point where these values are going to flatten or drop. I don't think we can continue this rate of increase. It's just an unsustainable thing, particularly when it outstretches incomes. When you don't see incomes coming up at anywhere near that level, those two things collide at some point. You have people making not enough money who are buying homes way more expensive than they should be buying. Eventually, that goes boom. So that's why I suggest what I suggest. And of course, that's my opinion. If you're convinced that San Francisco and other big areas that have seen crazy amounts of increase in home prices are going to continue to do so, that's a perfect way to go. And I've had investors who've had success with strategies like that in other markets where they go ahead and take a negative cash flow on a month-to-month or maybe very little cash flow just based on this idea that as they're holding the asset, it's just getting worth more and more and more. And then they liquidate in a year or two or three, whenever they feel like they've sort of hit a point where they can pull enough out of it that it's worth it for them. Okay, now, so a quote from Dennis Cisterna, Rent Range Data Services, Chief Revenue Officer, quote, "The first step every investor should take when looking to invest in single-family rentals is to conduct due diligence by researching historical housing and rental data, the local economy, and property-specific financial information like insurance, taxes, gross yield, net yield, and cash flow." Totally support that. I think that's a great way to go. Only 4 of the top 25 markets included in the high-yielding list show a decline in rent over the past year. But here's the top 5. Number 5, Rochester, New York, with a 15.6% gross yield. Change in rent during the first quarter increased 2.1%. Average vacancy rates 5.9%. And that's actually really good. There's only one other area that has a better vacancy rate than that. Number 4, Youngstown, Warren, Boardman, Ohio, Pennsylvania, 15.7% return. Change in rent during the first quarter increased 5.3%. Average vacancy rate 10.5. I usually assume 10% for my vacancy rates, even if it's less than that, just for a worst case scenario. Number 3, Milwaukee, Waukesha, West Allis, Wisconsin, 15.8%. Change in rent during the first quarter went up 3.8%. Average vacancy rate 5.3%. And they win the lowest vacancy rate of these communities. So that's good news for folks who might want to invest there. Let's see. Number 2 on our list, Cleveland, Elyria, Ohio, 16.6% return. Change in rent during the first quarter increased 0.9%. Average vacancy rate is 8%. And then again at number 1, and this is one that blows me away because and it leaves me wondering if I am completely missing the boat on this and need to really understand this market better. It's Detroit, Warren, and Dearborn, Michigan. 17% return on investment. Change in rent during the first quarter increased 0.9%. So tied Cleveland, Elyria, Ohio for the weakest increase in rent in the first quarter, and has a vacancy rate of 8.6, but saw a great return on investment on the year over year. So that's pretty compelling, and again, when we've talked about places like Detroit or Chicago, it's all about getting the ground truth. He mentioned up at the top of this that getting data is really important. And for something like this, clearly there's an opportunity here. I am not one to turn away something that's cranking out great numbers for investors. And Detroit's clearly doing it. So, maybe it's worth it to take the number 1 city and spend a decent amount of time in a show using the techniques that we've talked about here to try to drill down to the areas that you would want to look at in terms of investing in Detroit. And then, of course, ultimately, and I've had folks ask me this before. As I mentioned last week, I did a sort of a sit-down chat seminar thing with folks who were interested. I had enough folks contact me who wanted to get into investing. So it was just sort of a quick presentation of ways I thought they could get started, good habits to get into, those types of things. And then we just sat and did a question and answer session after that. And one of the questions they asked was, would you ever invest in something sight unseen? In other words, is what you're showing us, what you're teaching us here, that we could use to analyze a property enough for you to go ahead and write up an offer and potentially buy that property? And, the answer is kind of complicated because it's yes and no. Under certain circumstances, if my level of certainty and all of my data was right up there, and a person who I trusted gave me the inside scoop on that local marketplace and was able to communicate with me in a way that made me confident that I wasn't buying something in a demilitarized zone, or I had good data on similar properties in the same street or a couple of blocks over that were doing X amount of dollars, and all my data was solid, yeah, I think there would be a scenario where I would be willing to do that. I would do my level best to I would always be willing to make an offer, but would I be willing to actually close without physically inspecting it myself? I'm just not. Making an offer, yeah, I would be willing to make an offer sight unseen on some properties with the right data at the drop of a hat. But would I be willing to go all the way to the close of escrow and actually complete the purchase without physically seeing the property? And, I guess somewhere in the back of my head, I just don't feel comfortable doing that. And one reason for that is, and other people may have different experiences, but we talk about creating a team in the areas where you want to do investing that you feel like you can trust. And the reality is, if something did happen that blew that deal up, or that ended up being a bad purchase, I have no one to blame but myself. I can't blame the person who gave me information that they believed was correct, that if it had been looked at the way I would have looked at it, it wouldn't have been acceptable, right? So you have to own the process. And the only way you can own the process ultimately is to at least, and I think at a minimum, expecting yourself to get there physically to view the property is completely reasonable. It's a big enough deal that making the time to do it, even if it's just if you're someone who's working that full-time job, getting on a plane right after work on Friday, going and checking out the property on that Saturday, and then flying home on Sunday, that's an insurance policy. And maybe if it costs you several $100s to do it, I would pay that for the same reason I'd pay for a home inspection and pay $300, $400, $500 for it. So after we talked about it for a while, I kind of said, in a very rare situation, I might go ahead and go all. This would have to happen in a market where I feel extreme level of confidence in the people who I'm working with, and I've already had successes with those same people. So I guess the real answer is, if you're a starting out investor, no, it's not acceptable. If you're an experienced investor, if you have an existing team in the area, let's say I finally jump on board and buy in Charlotte, North Carolina. Excuse me, Chattanooga. Chattanooga was sort of my. I still have a bee in my bustle about the whole Chattanooga thing, and I'd love to go check the town out. But let's say I go ahead and I do an investment there, and I get a property and it does well for me, and I had my real estate person that I was working with there locally, and maybe I had a contractor who I had go and take a look and create a realistic list of stuff that needs to happen in order for it to be up to snuff and get me a good rent. We go through that process. Everything's done. I bought it. I took the advice of the contractor, had them do the work, and when it was all said and done, I got great renters in there, and everything's going great. I'm positive cash flow, and things are working. And I discover through that process of working through that and being there in person for that first transaction that, yeah, my contractor really gave me good advice. Yeah, that real estate agent really did know this local marketplace and gave me good info. Great. Then maybe the second property or the third property I buy, I don't need to go out there. But then you've also done something else. By going out there yourself for that first transaction, you've gotten a little bit of ground truth in your head. So then I think it's all right. Okay, folks, we had some interesting data today. I hope some of this has kind of given you a little bit of fuel to take the next step in figuring out what you want to do with your real estate investing, or maybe just shown you some communities you'd like to learn more about in that top 5 that are making investors some good money. As always, the goal here is for you to feel like the time you have spent here with me today has been well spent. Hope that's true. Thanks again for listening, and I'll talk to y'all next time.